Good evening. Welcome to the Financial Literacy. It is brought to you by the Financial Literacy Foundation in partnership with Mana TV. Thank you for joining us, and I believe that we will take this journey together safely. First of all, allow me to thank and appreciate our senior pastor, Pastor Joylene. Woman of God, thank you very much. We really appreciate your taking us on board to help assist in making life a better thing to do. And thank you also to our general overseer, Pastor Strike. Thank you, man of God. Thank you for taking us on board, for giving us this opportunity, for creating these platforms for us to be able to share this much valuable information to people out there. Thank you. Today we are on lesson 26, which is the third, if not fourth installment, while we're still talking about credit agreements. And specifically today, we are talking mortgage bonds. We started with this just last week, where we introduced the concept of mortgage bond. And I believe that you have grabbed something. Just to recap on that, we said mortgage bond, it's a credit agreement or credit facility which is aimed specifically at purchasing immovable property, to purchase houses. So this is very important because we need to grow our wealth. We need to develop ourselves. I said that we cannot keep on renting, because actually we might be renting where we still find that we can actually afford to have our own properties, where we could be buying and paying off our properties just by the same amount of the rent that you are paying. Some of us, we are paying rent on these high level estates, where actually you could have afforded to get yourself a good property which you could be paying your own bond with the same amount. I said we cannot come with this notion that I don't want to get into bond agreements. I would rather build by myself. There's nothing wrong with building, just like we said the other week, where we compared buying a vehicle cash versus buying a vehicle via credit finance. So same applies here. You might say that you will rather build for yourself, which I said it's good also, but you might find that it might take you quite a long while for you to save enough money or to accumulate enough money where you'll be able to buy. You can still buy 2-3 bags of cement every month end, but that will take you a while. So you might prolong quite well to have your own property. It may not be your dream house that you are buying into, but you can be able to move into your dream house even as you move on. Myself, the property I live in now, I did not start there. We started off at a very different property, very different area. But as we went on, we could sell and upgrade, develop, sell, and upgrade. So you can take this advice, my friend, because you can be able to change your life also, even as you do that. We said a mortgage bond, it's a long-term finance, or it's a long-term credit agreement, which you will pay for a while. And we want to understand how can we make use of mortgage bond to improve ourselves. How can we use mortgage bond to acquire, to purchase property? So we can start off in purchasing a house. How do we purchase a house? Besides the price that you will be charged, besides the price that you will see maybe on the advert where they say this property is 600,000 or it is whatever amount that you are qualifying for, there are other few things that I would like us to bear in mind in order to prepare ourselves to move to the next level when it comes to property accumulation. First of all, it's the property transfer costs. You will need to have sufficient funds to pay for the transfers. Because when you buy a property, unlike buying many other assets that we are familiar with, property must be registered. So you need to have transfer costs. These are transfer duties, or it's merely a tax that you pay in owning a property. So you will be charged a tax when you buy a property. But good thing is this is a once-off tax. So it's a duty which you pay on transfer or on the registering of the title from the previous owner into your name. And this tax depends on the value of the property. So someone buying a 600,000 property and getting it registered will pay a different transfer duty from someone buying a 1 million rand property. So in that way, you find that we need to be able to have a proper calculations done beforehand, so that this is part of the preparations, by the way, beforehand, so that we can be able to know when I've got that property, what else will I have to be paying. So if the seller is also registered for VAT, for instance, so in other words, he's a VAT vendor, there will be no transfer cost to be paid in that particular property, because in terms of tax, you cannot pay transfer duties and VAT at the same time. It has to be one of the two. So, and also, let us also understand that there is no transfer duty in South Africa on properties valued at R1 million and less. So if your property is worth 1.2 million that you are buying, you will only pay the duty on the 200,000. The first 1 million will be tax free. The second expense that I want us to know, it's the conveyancer's fees. These are the fees that are paid when the transfer is done also, because the transfer is done by lawyers. These lawyers, we call them conveyancers. So they charge a fee for them to be able to do such kind of duty. So these are merely professional fees. It does not go to this office or to the seller or to any other person. It's the fees for the services of the conveyancers. Then we also have the deeds registry fees. So these are the fees that are paid for the property registration at the deeds office. So this amount also varies according to the amount or the value of the property. So, and then the fourth one is the sundries. These are postage and petties, because upon registration, there will be quite a number of communication and transacting between yourself and the conveyancers, and between the conveyancers and the deeds office. All of that, it will call for petties and postage to be paid for. So all of that will be paid by the person buying the property. So these are some of the expenses that you're gonna look at when you buy the property over and above the selling price. And if you are buying using a mortgage bond, now we add over and above that, because the bond also, just like your property, the bond also needs to be registered. So we are talking of the bond registration costs now. There will be conveyancers fees, because it will be the attorneys that will be doing the registration. And then there will be deeds registry fees, just like we said, and the sundries. So all of that will be charged against the buyer. Yes, there are some of the things which the seller will be liable for, but all of what we have mentioned thus far is the cost to the buyer. And what are other costs? There will come municipal property rates and taxes. Some of them will be a once-off thing. Some of them will be a monthly thing. Sectional title levies, if you are buying in a sectional title area or in a security village where you are not on a freehold or a freestanding property. So there will be also body corporate levies or body corporate rates. And then there will be service connections. Remember, when you buy this property now, there will have to be disconnection or discharge of the previous owner into your names. So all of these will call for connection. It could be water, it could be electricity, it could be a number of other things that might require such connections. The estate agents commissions are paid by the seller because it is him who is selling. Then you may have to pay occupational rent should you have to move into the property that you are buying before registration take place. So in other words, you sign an offer to purchase today and you move in immediately before registrations take place. Then it means you have occupied the property before the actual ownership transfer, before the actual change of names into your name. So during that period, you will be paying occupational rent. Now, let us look as to how do we buy a house. We have seen the expenses or the costs, which I said they are over and above the selling price or the price in which you are buying the property. So let's talk of guidelines now on how do we go about acquiring that property. Why are we talking about this? We want to elevate. We want to move up. We want to accumulate. So we need to be able to know how exactly we go about. It might sound simple for someone or people who have already purchased property. But for someone who has never bought property but desiring, or who has never owned a property but feel like I cannot rent forever, it's about time that I upgrade my economic life, my state of economy, where now I become an owner of property. And you will have done well. How do you go about that? First of all, you need to find out the amount or the size of bond that you can qualify for. Yes, you may want to start from the area where you want to buy. It's one way, but that can be frustrating at times. So I suggest that you start off by understanding, getting a good grip or a good picture of how much can you buy or can you qualify for. So some banks, for instance, will give you what we call pre-approval certificate. They simply assess your finances based on your income and the possible property that you may want to buy. But remember, in this case, you may not have the property as yet, but they can be able to pre-qualify you and say you qualify for a bond size of 700,000. So, which means if maybe you were looking for a property at the price range of 800,000, that means the other 100,000 will be coming from your pocket. So, number one, we get the value or the size or the picture of how much can I buy for? What price range can I be looking my property? And when you've got the pre-approval certificate, you are also easily able to use it to negotiate prices. Remember, property prices are fixed by the owner. So if you want to buy a particular property, there may be other properties exactly like it, but the price could be different. So it's the owner who determines the price over and above all the other things that we think of, which is the valuation and the area and so on and so on. So I said, if you are looking at a price range of 900,000 and the bank says, will you qualify for 800,000? That means there is 100,000 difference that you may need to put down. We call that a deposit. So in other words, there may be a deposit applicable to your choice or to the requirements of the bank. Some other banks will say you will need to have a deposit. Other banks will give you 100%. There was a time the banks will give even up to 110% of the value of the property. These days, 100%, sometimes they give you lesser. Now, when you have determined the price range according to the value that you qualify for and determined whether there will be a deposit needed or not, now you can be able to establish the best interest rate that you can go for. So We haven't gone to the property itself, but now isn't it now you are negotiating with your bank? Remember, when you're negotiating with your bank, they make a proposal. They make a suggestion and say, okay, Chris, you will qualify for a bond of 700,000 and we're going to give it to you at 8.5% interest rate. It is not a done deal. It is not a given thing. You can still negotiate with the bank and say 8.5%, it's quite high. And you give your own reasons. But over and above that, you can be able to use that pre-approval to go to the other bank also. To go to the other bank and be able to negotiate based on that. To say, Bank A is offering me 700,000 at 8.5. How much are you willing to offer me at? And you'll be surprised to find that they are willing to beat the offer of the previous bank. So we establish the best interest rate. So interest rates will differ from one bank to another. They will also differ from bond amount to bond amount. So these are not a fixed things. These are things that you are able to negotiate when you take on a bond. It can do you well also if you make use of bond originators. Bond originators are the bond brokers. In other words, you go to one bond originator, put in your application, and they submit your bond application to all the different banks, all the different financing institutions, and upon receiving the bank's offers, they will help you negotiate, or they will help you choose the one which has got better conditions to the other. It may not necessarily be the bank that you bank with. And don't be offended if your bank disapprove you and another bank approve you. It's normal. It's the name of the game. So shop around for the better rates and shop around. A difference of 0.25% sometimes could mean thousands a month. At times, in actually fact, it will mean tens of thousands over the duration of your bond. So to be able to get a better offer at a mere 0.25% interest per annum, you have done quite well. So after establishing the interest rate and negotiating the interest rate, now you can establish as to whether this particular bank is able to include those costs that we started with. So I wanted to mention those costs first, the conveyancer fees, the registration fees, so that you can be able to see where they come in. You don't always have to have that cash. Some banks are willing to finance or give you the loan, including those costs. And some banks will only want to cover some of them, but not all of them. So whichever that you are getting, make sure that it is something that you are able to have it while you have negotiated. You are able to, it doesn't have to be given to say, come, let's sit down and negotiate. Whatever the bank is offering you, you have the right to go back to the bank, that consultant or whoever is assisting you, to say, but this I'm not happy with. Is that all? Is that the best that you can offer? This is the second contract or agreement where I said we can negotiate. The first was the vehicle finance. You don't take interest as given to you. You must never think that whatever the bank approves you on, that is all. And you must never think that they are doing you a chance. They are giving you about Chunela favor. They are not tuning you favor. They are also in the business. They want your business. So you have the capacity and you have the bargaining power, especially if your credit profile is good. Remember, weeks back, we spoke about credit profile and managing. We were building up to be able to talk about this type of things. When you have a good credit profile, you will be able to negotiate your interest rates and terms and conditions of your credit agreements. So after that, we said you establish whether your bank is willing to add or to fund the costs that are associated in owning the property. I said some banks can do that. Some banks don't. But now, after that, now we can be able to establish the monthly repayment that you will be paying. Because now we have the whole package. We know that this cost will be added, this cost will not be added. Which means then, I know that for those costs that will not be added, I have to know where will I get the money to finance that. Because it would be a pity to have the bank funding you for the purchase of the house and you fail to have 25,000 Rand transfer costs. You will have won on one side, but you are losing on the other side. And it might end up having the whole deal cancelled because you can't afford, or you end up on a wrong credit. So make sure that you are ready. The reason we talk about this is that you need to do your homework well and prepare in time to know how will I do what, where will I get the money for this, and so on and so on. Speaking of understanding now the estimated monthly repayment, let's talk a little bit about the bond installments. Now, the bond installment, it works slightly different from the many other credit agreements that we spoke about, because this one, it's a long-term thing, but other than that, we see a big difference on how interest is charged. We said, even last week, we mentioned this, that bonds interest rate is charged daily and compounded monthly. In other words, the interest rate that you pay, they calculate that interest rate on a daily basis based on your outstanding balance. Whereas on the many other credit contracts that we spoke about, interest is calculated upfront, and your installment, it's calculated based on that total interest, and we can simply say divided by the number of months that you will be paying, or you will be having the credit facility. Whereas with mortgage bond, it works out differently. Your monthly installment includes the capital amount and the interest charges. And some of us, we get so alarmed when we see our statements. You find that on a 7,000 Rand monthly installment, 6,800, it's interest, and only 200 Rand goes to capital. You should expect it that way, especially in the beginning term of your bond, because your balance is still bigger. So it calculates the interest based on your outstanding balance. That is why I said make sure that things like your insurance for the house, it's not put into the bond account, because every time your insurance premiums goes off, it leaves your outstanding balance bigger. In other words, you will be charged interest on money which is actually not even going to service your debt, which is the bond, but it's going to the insurance company. They may be together, but don't be confused. These are two separate, distinct contracts. One is for housing finance, the other one is for the housing protection, which is not a credit facility. So moving on, let me also say, paying off your bond early, it's possible. The fact that you have been given 20 years to pay off your bond does not mean you have to stick to the 20 years. In fact, I've done a lot of calculations to this effect. If you were to double your installment on whatever bond you are having from the beginning, if you were to double your installment, I know it will not always be easy, but I'm trying to show you a principle here. If you were to double your monthly repayment, you are likely to pay off your bond in less than 7 years. Yes, you might say it's still a long time. It is true. But some of us were paying personal loans and everything over and over in multiple times, where it comes to 7, 10 years and even over, on things that sometimes you can't even trace what you have done with the money. But with your bond, you are able to see, this is my house that I have bought. If you were to double your installments you are likely to pay off your bond in less than 7 years. It's six years and couple of months actually. So if you were to do even slightly more than that, you can pay off your bond in 5 years. The fact that it's a 20 years, it does not mean that you have to stick for the 20 years. And if you pay your bond early, you are reducing the amount of interest that you will have paid. I hear people say, no, but the amount that you will have paid after 20 years, it's 3 times. You will have bought the same house 3 times. It is true, because if the bank gives you their money for you to own a property, you must expect that they must charge you. So if you pay that money quicker, the lesser interest that you will have paid. So the lower the term, the lesser the interest charge. I did say doubling your installment, you will pay less than 7 years. And if you were to add if you were to keep your if you were to keep your installments at the same rate when interest rate comes down, like now we know that interest rates have come down, those who have been wise, they will have left their monthly repayments on their bond at the same rate. You could be shedding off 4 to 5 years of the term 20. So you will pay off your bond in less than 15 years. So it is possible, friends, to have your bond paid off. It's just that these things we are never taught. We have ability, formulas to calculate. You can come and say, if I want to add 200 rand from my normal installment, how many months will I cut off? How much interest will I be saving? We will be able to give you that. So let's get used to this. Let's get to understand that we can do better with the current existing facilities. And let me also say, because you have paid so much money in registering your bond, it is not a must, my friend, to cancel your bond once you have paid it off. You can leave it lying there. The bank will not force you to close off the bond. As long as you don't owe them, or as long as you can leave maybe a small amount just to keep the facility on. It's not a must to have an outstanding balance. But that is an expensive facility to register. So don't just cancel. Don't get excited in that I've paid it off now. I want to. Some of us will do this because we want our deed, a deed of grant. What do you want to do with it? In fact, it is better off lying with the bank there than to be in your drawer where it can get lost, can get stolen, and so on and so on. And you will have to do a duplicate if you happen to want to transfer the property in the future. My friend, do you have an extra 5,000 rand, 6,000 rand? Are you paying a rent of 7,000 rand, 10,000 rand where you are living? Stop that. You can have your own property. You can have your own property where you are not paying someone else's bond. So your repayments, your rental payment are actually your bond installment. And in conclusion, let me remind you that when you have your bond, if they give you one of the conditions being that you must have a life cover. You must have a life cover. But here is the thing. You don't have to take the life cover that is offered by the bank there and then. You can and you are allowed to shop around. In most cases, the premiums on those ones which are offered by the bank, because in much instances they are not underwritten, you find that it's quite high. And while you can qualify or you can afford to have your own property, so you can have your own insurance, you can even use an existing insurance policy to cover. But at the end of the day is that don't leave that bond without a cover, because in the event of your death, you will be dying with your salary, and we don't want the family taken out of the house simply because we have decided to meet with our maker. So we must have a a policy, and this policy must be correctly structured. It must not be named or having a beneficiary as one of your children or your spouse or whoever else, but it must be the estate which is the beneficiary, because it is your estate which will be paying off that debt at the time of death. My friends, I know this is not an easy topic when we are not, because we don't talk about these things too often. You have our numbers on the screen. Please feel free, give us a call. Let us help you to navigate through these kind of things. We will not even charge you to help you with information of this. We will be willing and ready. Through the Financial Literacy Foundation, we have made it our business to make sure that you are financially literate. And thank you very much. Thank you for joining us. Thank you for being with us tonight, and may God richly bless you. In Jesus' name, amen.